Welcome, and thanks for tuning into KBRA podcasts. We cover topical research discussions, industry commentary, and more. As we continue to expand globally, KBRA Podcast is a go-to source for timely briefings directly from our knowledgeable team members. In today's episode, USD, UST, and Sovereign Risk, Joan Feldbaum-Vidra, KBRA's Managing Director and Head of Sovereign Ratings, will discuss recent dynamics in the dollar valuation and the recent rise in Treasury yields, and what this means for global sovereigns, especially in emerging market economies. Stay tuned to learn more.
Hi, this is Joan Vidra, and thank you very much for joining me today for our latest Sovereigns podcast episode. Today, I'll unpack some dynamics that have been pretty hard to ignore over the past few weeks and days for sovereign and global investors. And I'm referring to the weakness of the US dollar and the recent dramatic increase in Treasury yields. And I'll tell you about our views and what this all means for sovereign risk. But first, briefly, a bit of a teaser on what you can take away. Despite the heightened discussion of a possible taper-like tantrum hitting the emerging markets, and the risks this poses, our main view includes the following points. First, we believe many sovereigns are in a better position today than they were at the time of the original taper tantrum to withstand the pressures. Second, just the sheer fact that we're having this discussion points to improvements underway in the U.S., which is, after all, a good thing and constructive to the global economy. And third, sweeping generalizations about sovereigns are often misguided. Sovereigns are all very different, have very different levels of resiliency and very different debt profiles. So please hedge your bets before drawing any firm conclusions about individual credits that seem misaligned with the commentary I will provide. But before we get to the crux of this podcast, let me also make some very brief comments on what's been contributing to the dynamics of U.S. dollar weakness and rising U.S. Treasury yields. Now, we don't know if these dynamics will be sustained, of course, and note that there's been a lot of volatility in recent days, but it is worth highlighting what we do know, and that is, we have a much faster pace of recovery in the U.S. than we expected originally, and partly that relates to accelerated distribution of vaccine jabs, much faster than what we're seeing elsewhere in the world. Second, the U.S. consumer is doing its job, spending away. The large pools of savings amassed in bank accounts provides U.S. consumers more comfort to spend, even regardless of the unknowns about future employment prospects. And of course, the imminent fiscal stimulus also helps pad the cushion. Third, U.S. dynamism. The U.S. is dynamic, flexible, and innovative, and we already are seeing animal spirits starting to bare their teeth. We have absolutely had massive amounts of creative destruction taking place since COVID-19 broke out, but we also have a lot of creation that's likely to be forthcoming. Now, as credit raters, we're not naturally half glass full types of people, so we are very concerned that the U.S. will not be operating at full potential for some time. So I say these words about dynamism with a bit of caution. And fourth, another important backdrop is that while it seems decades ago, the U.S. election has been a force. On balance, we all expect more cooperation as compared to confrontation out of the new administration. Progress just announced on the international digital tax effort is the most recent example of this. So, it's against that backdrop of generally constructive developments that we have low for long interest rates by the Fed and other major central banks as well, while inflation is accelerating, even if way below target, still, and generous helicopter money that just dropped like manna from heaven, plus a whopping amount of more stimulus on the way, largely directed to households. All of this is adding to inflation and inflationary pressures. So it's the thrust of policies, largely, that has contributed to U.S. dollar weakness, as well as U.S. Treasury yield dynamics, all of which are generally favorable to the global macroeconomy. First, let's unpack U.S. dollar weakness. Should it be sustained? And what that means for sovereign credit. Well, of course, the corollary to U.S. dollar weakness is strength of the other side of the currency pair. That means that other countries, in general terms, are witnessing their currencies appreciate. And some don't like this at all and are intervening to make sure their exchange rates remain competitive. as export growth is often key to recovery in many very export-driven economies. It will be interesting to watch how that dynamic plays out. We've already witnessed several central banks in the EM and AI worlds start to intervene in support of weaker currencies. But this is far from a theme. Actually, despite the nominal appreciation of several EM currencies, they've actually, in real effective terms, they have depreciated since the last taper tantrum in 2013. So what this means is that today they are more competitive than they were back then. It's also important to note that while countries may not love the impact of a nominally appreciating currency on their competitiveness, it certainly does help debt payments prospects for US dollar debt. So let's unpack the next point, yield risk. With yields rising in the US, there is speculation about a Fed hike. And taper tantrum is once again becoming a phrase of the day. The concern is that yields in the US will force up yields in emerging markets, that's already started to happen, and that it will be pricier to pay for large debts that have been accumulated for COVID. But a couple of points here are important. First, it seems the Fed is pretty firm about its low for long policy. Second, many emerging markets have improved their debt structures. They're not as exposed to foreign currency debt. They've lengthened out their maturities as well. Also, local yields in emerging markets in real terms are actually higher than they were in 2013. At the same time, external risks are more moderated. Countries have built up their foreign exchange reserves, they're not overheating, and their debt profiles, like I said, reflect a greater balance towards local currency debt over foreign currency debt in many emerging markets. Again, these are very general comments. Now, of course, we can't ignore the large debt loads that all countries across the world have accumulated, and also the unknowns about economic recovery, particularly in the emerging markets. We don't know what a post-COVID world will look like, indeed. And recovery is more remote in the rest of the world than it is in the US because of the slower pace of vaccine distribution. Rising debt costs will put the brakes on countries who are slower to recover. As such, rising yields are happening at an inopportune time. So to wrap this up and zero in on what US dollar weakness and the recent rise in Treasury yields means for sovereign risk, here's KBRA's view. First, improving conditions in the United States is generally beneficial to the global economy. Second, many emerging markets are in a stronger position today than they were at the time of the last taper tantrum, even in spite of the very acute fiscal risks that have developed due to debt accumulation from COVID-19. Third, the nominal yield environment today seems like a cakewalk compared to what emerging markets have felt in the past. Overall, in KBRA's view, sovereigns have been way more resilient than we anticipated, let's say back in April or May. That has to do with the pure nature of the COVID shock and the shape it has taken. There are absolutely higher credit risks in the world's most fragile economies, no question about that. And for economies with weak commitment to fiscal sustainability and weak growth trajectories, and for those most at risk of a clear K-shaped recovery, the risks are more acute. It goes without saying that KBRA will continue to monitor closely its portfolio of sovereigns as these dynamics evolve.
This concludes our episode. Please continue the conversation on LinkedIn and Twitter @CrowBondRating. We'd also like to remind you that all of our ratings and research reports are free at KBRA.com. Lastly, please share your ideas for future podcast episodes or any feedback to media@KBRA.com. We hope to see you next time.